Investors and traders, welcome to the channel Market Chart Pattern. New subscribers, welcome to the channel, and our regular subscribers returning to watch the video. Thank you very much all for supporting my work and taking interest in my work. This video is for educational purposes only, and it is not a financial advice. In this video, we are going to take a look at the key US stock indices, but we are going to start the video by taking a look at credit markets, bond markets in particular. So what we are going to do is at the beginning of the video, we are going to discuss briefly this issue with the US debt ceiling, which is coming in due by 1st of June 2023. So we have got less than 4 weeks left. And what we are looking at is the chart of United States 1-month government bonds yield. And what I would like to draw your attention to is that, look, if we just go back around 20th of April, look at this move. So this is when this move has really started, and it's a pretty steep move. And what we are looking at is around 5.686%. This is what it is yielding right now. Now, what I would like to bring to the attention is that the stuff which is going on with the US debt ceiling, we need to pay close attention to that now, because the market is telling us that it has something serious to it. Now, in the years past, what we have seen is, and especially in the recent years, because of the political reasons, there have been discussions, dialogues, etc., and the debt ceiling has been raised to avoid a possible default scenario. In this situation, currently, because of this steep move, the market is telling us that it is actually paying a lot more attention to this aspect as the time draws closer to the 1st of June. And we should do the same, because it's going to have an impact on the US stock market. All the markets, but in this video, we are going to cover the main US stock markets. So this is what I wanted to bring your attention to, looking at the US 4-week or a 1-month government bond yield, and look at this steep rise in just about, starting not too far, but if we go back to around 20th of April, it was yielding on the closing basis around 3.43%, and it has added a little above 2 points to it. Okay, so this chart which we are looking at now, it's coming from the investing.com, and this is the US CDS, which stands for a credit default swap 1 year. And again, what I would like to bring to your attention is, look, as of the 28th of April 2023, there has been a steep rise in the price of the credit default swap. And what it indicates is an increase in the price, that there's more demand for it. And institutions, the big players, they seem to be buying some insurance. So this is what it is. It is a CDS is sort of an insurance on the credit, on the debt for a company. In this case, it happens to be United States. So keep this in mind. Now, what I would like to do is, we are going to take a look at the US Treasury bond futures, which is actually also known as the long bond futures in the trade, because the 30-year duration is a pretty long duration, so it's known as the long bond. And what we are looking at is the Treasury bond futures 30-year maturity. I'm not going to go into too much detail of the patterns and the levels. I'm going to put a link in the description and also at the end of this video, where you can go and watch the video which was done last week, in which we had really covered the US bond market for the 30-year and also the 10-year note. So guys, here what we can see is that there is a confluence level of about 50% and 38.2% ratio coming in here. The market has been in a trading range since the 13th of March, and what is really key is this level of around 128.30. If the market breaks below that, then it is likely that it's going to go and test this level of towards the bottom of this trading range, so it could go and actually test 125. Breaking below 125, that will be a break of the 78.6% Fibonacci retracement, and also it will be below the 20-day moving average. It's gonna go and challenge these lows here, and below that what it would indicate is that the bear market is back, and we could be looking at a pattern of A, B, C, D going much lower, which obviously is not gonna be a good sign for the stock market as well. So it's important that for now we just keep an eye on the bond markets. Bond markets are much bigger than the US stock markets, especially the treasury note market is several times bigger, and they are much more interest rate sensitive. They are much more sensitive to credit events, and we are likely to get a lot more clues from these markets. That's why we are discussing them. Okay, let's take a look at the ZN. This is the 10-year treasury note futures contract, quite similar to what we saw for the 30-year long bond futures. We have a confluence of 38.2% Fibonacci retracement and 61.8% retracement coming together. Also, the concept of market symmetry, the bearish symmetry is still in play, which is it moves of the equal magnitude. There has been an attempt to break out of it, but what we are seeing is also a tough resistance coming in on 1 time, 2 times, 3 time, even also 4 time. We have also had this ABCD kind of a formation here, roughly speaking, and breaking below, going below this level of 115, which is the 61.8% Fibonacci retracement. We could see actually a retest of the lower end of this range, breaking below this part. Let's actually quickly have a look at where is the 338.2% Fibonacci retracement. So there we go. So if we break below this range, then the chances are it's gonna go and test the 61.8%, and then to a 78.6% Fibonacci retracement, which comes around 112 111 and 27, because these markets are priced in the 30 seconds. That's the way the code is for this. Breaking below this, just like what we saw for the the long bond futures, we could have a bigger ABCD cycle going to the downside. Now let's just quickly take a look at the ES, which is our E-mini S&P 500 E-mini futures. I am not going to go into too much details here, just to keep the video short and sweet. Not much has changed in terms of the the support levels and the price projection levels that we were looking at. So what I will do is I will put a link to the video which was done last week, and also put a link in the description. So I will highly recommend that you go and watch that. Here, what is really key for us is one of the pattern formations we were looking at was this possible ABCD formation right here, which could in fact see the stock going, this index going to 4430. On the weekly chart level, we also have a higher level where in fact we could see price go as high as 4450 and even 5525. However, that is all dependent upon what's going to happen with the stuff going on with the debt ceiling, etc., and what to do, where to take the clues from, whether this ABCD pattern, the smaller one here, is in fact in play. The real key is that this 38.2% Fibonacci retracement around 4060, that needs to hold, because that is the point C of this pattern we were looking at. If the market breaks below this for on 2 consecutive daily basis, then what it indicates is that this pattern perhaps is no longer in play, and the market is giving us clues, and the structure might be changing. But for now, we are going to go with our analysis and look for this support region to hold or not. And also at that time, shorter term momentum coming in from the 20-day moving average would have changed negative as well. So on momentum basis, the market will also be having a negative momentum. Okay, so let's take a look at the NQs. All right, guys, so the NQs, something important about the NQs, I'm going to clean up some stuff here in the NQs. So I'm going to clean up these some support levels we were looking at, and some resistance levels. So let's just clean up a little bit the market symmetry there. And what I am also going to do is, because it's so close to this structural resistance here, there is something really important happening as well, where the market is trading right now. So the market is right at the 61.8% Fibonacci retracement, right where it closed pretty much last Friday. So let me actually put that 0.618 retracement. Let me make it a little bit smaller. Here we go, right here. And that's very important, because what we have to do now is we have to really watch the price action in the, I'm also gonna get rid of this thing. We really have to watch the price action in the NQs, because the NQs have been the stronger ones. They have been the index which have been the one which have been leading. Technology was one sector which was really punished very harshly because of the rise in dramatic rise rather in the interest rate in 2022 and also earlier part of 2023. But since October 2013, we have seen a base formation kind of being formed here, and the tech stocks have been leading, in fact. So this index has been much stronger, but because of this 61.8% retracement coming right here, we have to pay close attention to this, because if it's gonna go and break the support levels and also this 20-day moving average, it will be an early indication that we are encountering strong resistance, and the stuff going on coming from the bond markets, the credit markets, because of the situation with debt ceiling is likely having an impact from a fundamental perspective, and we could see a steeper correction in the markets. Now in this video I'm not going to go into too much detail of how much if the correction were to take place, what levels to look for support. What we should look for is this market symmetry. So you look at this, in this rise the corrections have been of this much. So if excuse me, if there is going to be a move coming to the downside, what we should look at is this market symmetry. So around 12,800. So this, let me actually mark it. Here we go. So this 12,800, also write it here to watch for the downside. Let me actually make it a little smaller so we can fit it in here. This is gonna be the first clue that things are changing, because it would mean market symmetry broken in this leg at least, and also the support level broken to the downside. The next part will be this possible structural support coming from this entire region. Let me actually try to highlight it for you. This is a roughly very broad kind of a region, but if it begins to close below all of this, then things have changed in the marketplace. From a structural perspective, our clues will come from this market symmetry and the support level around here being broken to the downside. We typically like to see 2 consecutive daily closes, either up or down, depending upon what we are looking at for support or resistance. So this is what we are watching for the US stock markets. We covered the bond markets briefly, and the 2 important charts that I showed you about the US credit default swap and also the 1 month US yield. That is very important to look at. So as always, thank you very much for watching the video. If you like our analysis, how we look at the markets, how we look at the pattern recognition, we look at important Fibonacci retracements, price projections and expansions, and put everything together, and we are able to look at support and resistance level and forecast what the price might be likely to do next. Then please do subscribe to the channel, and if you like this video, you found it of educational value, then please do hit that like button. That is just an indication personally for me that people find the videos of educational value, and it just encourages me to bring on more videos for you guys. So thank you very much for watching the video. Good luck and good trading. Thank you. Bye.